Thanks, Irene. That was a nice introduction. I appreciate it. Feel good while I'm up here. I like the graphic. It's, I think, the long arm of the CRA there shaking out the pennies. But we'll talk a little bit more about that as we go along. Feel free to interrupt me to ask questions, but I'll try to work through the material and save most of the questions for the end. That way we can address it as a whole package, because some of the material might address the questions as we go along. First of all, I'd like to thank everybody for having me here today, and it's a pleasure to meet everybody. I look forward to learning all about your social ventures and where you're going from here. I promised my wife that I wouldn't take a long time at relegating stories from the past out to the presentation, because it might take up the entire 30 minutes that I have. But I just wanted to explain that I have not always been a lawyer. I started as an engineer in the late 90s and the middle of the dot-com boom. And I started a clean technology company with a professor of mine in Redmond, Washington. So I'm fairly familiar with sort of the areas that are focused on here today, and certainly corporate social responsibility was a large part of the businesses that I was involved in at that time. And so hopefully I'll have an opportunity to talk to you all about my experiences and the long road ahead, I suppose. Again, knowing that where you all are, tax is probably not the first thing that comes to mind when you're thinking of how to progress with your particular venture. But it's really not about tax that I'm talking about today. It's how to maximize the flexibility of your business structure. It's how to receive incentives from the federal government in respect of expenditures that you guys make in your ventures. And it's about maximizing the after-tax income of your ventures to ensure that you can provide the most benefit out of these different ideas that you have and you're developing right now. So I like to compare tax planning a little bit to squeezing an orange. You can put it on the press, and you can press a little hard, and you get a lot of juice out. But if you press really hard, the harder you press, the more benefit you get out of it. Of course, the CRA likes to sort of remove your hand from that press, but that's the difficulty that you'll face. So in tune with the ideas that we're talking about today on social responsibility, I'm going to give an overview of not only for-profit ventures, but also touch on charities and nonprofit organizations. So first of all, a nonprofit organization, I'll just refer to that as an NPO versus a charity. When discussing charities and NPO, it's important to recognize the differences between these two entities, as they're often confused. Nonprofit organizations and charities can be corporations, either share capital corporations or non-share corporations, have members. They can be trusts, partnerships, or unincorporated associations. There's no specification for what business structure you can use for either a charity or for a nonprofit organization. However, charities are very specific, and they must be organized to satisfy some very specific conditions, and they must be registered with the CRA before they will be considered a charity. So the first of the conditions that are required to become a charity are that the organization's purpose has to fall into one or more categories. These categories are the relief of poverty, the advancement of education, the advancement of religion, and certain other purposes that benefit the community as a whole. And those purposes are outlined in case law that deals with charities over the years. If you don't fall within those criteria, essentially you cannot be a charity. Secondly, charities must also devote all of their resources, so that's money, personnel, and property, to charitable activities that further the charitable purpose. And I emphasize the word all of its resources. That means that you can't have an employee of a charity working on a for-profit venture. You're not allowed to use money from your venture for your non-charitable purposes that aren't outlined. Those are things that the CRA will take to remove charitable status from organizations. And finally, the organization must demonstrate that it provides a measurable benefit. And this is often a difficult thing to achieve, a difficult thing to prove. The people who are eligible for the benefits also have to be the public as a whole or a significant subsection of it. It's important to remember if you're considering setting up a charity that charities, to set up a charity is very time consuming and costly. It's often prone to be highly monitored by the CRA, and it's often audited. So you have to open your books. There's often a lot of accounting and compliance costs associated with charities. Just talking a little bit about nonprofit organizations. Although charities also operate on a not-for-profit basis, they are not nonprofit organizations. Unlike charities, the nonprofit organizations are not required to be registered, and nonprofit organizations, of course, can't take advantage of the CRA policy allowing official donation receipts to be deducted from individuals' tax returns. Another important difference between charities and nonprofit organizations is that upon dissolution, a nonprofit organization can distribute its assets to the members that form that organization, and it's freer to distribute those assets in any way they see fit. However, a registered charity may only distribute remaining assets to other registered charities. Something to keep in mind as you go forward and plan on which structure makes sense for your venture. So there are three main criteria that must be satisfied in order for a nonprofit organization to receive tax-exempt status under the Income Tax Act. First, it must be a club, society, or association, and unfortunately these terms are not defined in the Income Tax Act, and so there's a little bit of unclarity in satisfying this criteria. They also cannot be a charity. So if you have a registered charity, it's not a nonprofit organization. But most importantly, the nonprofit organization must be organized and operated exclusively for a purpose other than profit. Now what that means is that the organization cannot have a profitable purpose. They cannot carry on income year over year generally. They can keep a reasonable reserve, but that reasonable reserve must be used for a long-term nonprofit purpose. So the bylaws, the articles, all the documentation must adequately describe the nonprofit purpose of the organization, and its activity must reflect that nonprofit purpose. So for instance, the organization can't receive certain types of income. A nonprofit organization can't receive fees, management fees, rent, or interest. And if a surplus exists, or if those type of income are income that would like to be received by the nonprofit organization, one strategy might be to create a profitable subsidiary of the nonprofit organization and funnel those type of profits, those type of income through that nonprofit subsidiary. So finally, the last criteria is that no income can be payable for the personal benefit of proprietors, shareholders, or members. And really the CRA takes a hard line with respect to this criteria. So even salaries that are deemed to be higher than a general salary for that type of position can be viewed by the CRA as providing members or shareholders a benefit that exceeds what their salary should be. And so if any of these criteria, any of these three main criteria are not met, then the nonprofit organization can lose its tax-exempt status. So the CRA comes and audits nonprofit organizations. In fact, over the last few years, they've had several initiatives to audit nonprofit organizations and to investigate whether they should remain as nonprofit organizations or not. And the implications are fairly severe. If it's audited, they go back several years. They can go back as many years as they have records for, but generally 4 years and sometimes as much as 10. And they can assess penalties and interest in respect of any income that they could deem to be payable by the organization. As well as the fact that under GST/HST law, there's also penalties and prosecution in respect of not remitting and withholding amounts for GST, HST. For-profit business structures. As Arun outlined, the simplest form is a sole proprietorship or a partnership. Now with a sole proprietorship or a partnership, it's not a separate legal entity, so any of the taxation that occurs through that entity. It's referred to as a flow-through entity. Essentially what occurs is that the income that's allocated to each of the partners, it's allocated through the partnership. So although the partnership will be required to file a return, that income is income or loss of the person behind the partnership. The main advantages of a sole proprietor partnership is that early term losses can be applied against other income. So if you're an individual and you have employment income or you have business income from other sources, you can use those losses of the initial startup of a sole proprietorship or a partnership to act against the income that you otherwise receive, and thereby reducing your taxation and providing you with a benefit that you can in turn use in that business venture. When you have a corporation, it's a separate legal entity, so any losses that are incurred are wrapped up in that legal entity, and those losses can only be used against income that's gained by the corporation. So they're completely separate entities. The other thing that I just want to mention is that as a sole proprietor or partnership, there are rules under the Income Tax Act that allow you to roll over property that you maintain in your sole proprietorship or partnership at a time when you create a corporation. And that's going to be done on a tax-free basis. So if you have intellectual property or goodwill or even a customer's list, those can be eligible property that will increase in value as you develop your business. So you start your business, you don't have very many customers, your intellectual property is not well developed, that'll gain it'll gain value over time. Now if you sell that to a corporation, so you create a corporation, you sell that property to the corporation, generally a capital gain will be assessed to you personally. So the value of the property that you originally received compared to the value at the time that you sold it to the corporation will be assessed to you personally. But what the Income Tax Act allows is a rollover of that property to the corporation. So you can roll over it into the corporation, and then when the corporation goes to sell it, they will incur the tax liability that you would have otherwise incurred. Now, the main area that I think provides a lot of the benefits under the Income Tax Act in respect of small corporations or corporations that are initially starting out are under the corporate tax section. Now, you should remember that as a separate legal entity, the only way is really that you get income out of the corporation if you want to be paid by the corporation, is you get paid through dividends, shareholder dividends, or you can receive management fees, or you can receive wages. Those are the three main areas or ways that you get income out of the corporation. But you have to remember that the corporation is taxed as well as the individual. So when you receive a dividend out of the corporation, that income is taxed within the corporation, and it's also taxed when you take it out of the corporation. Now there's some dividend tax credits that apply, so some of that taxation is removed, but it's often not advantageous to have dividends paid out of the corporation. You may want to consider things such as salary, to pay yourself a salary during the early term of a corporation. So what I want to talk about a little bit are Canadian-controlled private corporations, and there's a real advantage to establishing a CCPC at an early stage. And it's a fairly simple definition. It's Canadian-controlled, so it cannot be controlled directly or indirectly in any manner whatever by a non-resident of Canada. So if there's an informal agreement between a shareholder of the company in Canada and a non-resident that, hey, you hold the shares on my behalf, but I'm really the beneficial owner, that doesn't count. So it has to be owned by a resident of Canada, or the majority interest has to be owned by the resident of Canada, and it has to be private, so not traded on a public stock exchange. But there are many advantages to having a CCPC. There's scientific research and engineering, and development of refundable tax credits. There's a small business deduction, capital gains exemption, deferral of stock options, which I'll touch on. It's not particularly important to most initial ventures. And there's also a rollover that can apply where you can roll over the value of your existing business into a new business if certain criteria are met. I always forget to flip the slide, so if anybody notices that, just give me the hand signal and I'll make sure I get to the right slide here. But scientific research and experimental development program with the CRA is essentially a funding mechanism that allows CCPCs and other non-CCPC companies to invest in scientific research and experimental development and get paid for that research. So for a CCPC, they can spend what's called eligible expenditures, and 35% of those eligible expenditures they can receive back as an income tax credit. Now, at the early stages of a corporation, often you don't have income. If you receive that credit back and you're CCPC, you can get that credit as a refund. So you can that 35% may be refundable to you. But if you're not a CCPC, first of all, you only get 15% credit, and it's never refundable. So even if you don't earn any income, you can't get that money back out of the corporation. But it can provide a significant advantage for certain types of expenditures. The real crux of the CCPC, the real advantage of having a CCPC is that the first $500,000 worth of income is taxed at a very low rate of 15.5%. Generally, corporations, both federal and Ontario taxation, their income is taxed at 26.5%. And non-CCPC, for the first $500,000 at 15.5%, provides you a significant advantage at the early stages of your company's venture. The other advantage is that every individual in Canada has a one-time $750,000 capital gains exemption. So essentially what this allows is that if your corporation has assets that are substantially used in an active business carried on primarily in Canada, then you can use this $750,000 capital gains exemption when you decide to sell your CCPC. So if you decide to sell, you'll get a capital gains inclusion in your income if it has increased in value from the time that you bought the shares to the time you sell the shares. And that can equal up to $375,000 worth of free income, tax-free income. So it taxed at 46%, which is the highest marginal individual rate. You're looking at $150,000, $160,000 difference from having a CCPC compared to not having a CCPC. There are certain criteria that must be met, however, including that they must be held for 24 months.
If you have set up as a partnership, can you change your arrangement to a CCPC, or do you have to do that?
Absolutely. Yeah, you have to incorporate, so it's definitely it's a corporation. As long as it's Canadian controlled and you have it listed on stock exchange, then you're automatically a CCPC. There's no registration requirement. There's no return requirement. You're just defined as a CCPC, and you can take advantage of those incentives. So there's a stock option deferral as well with CCPCs, and this is a little bit more complex in nature, and I'm not going to go through it in regular detail, but essentially on the exercise of a stock option, there's an income inclusion. So if you give a stock option as an incentive to one of the people who are either employees of your company or have some business relationship with your company, you have the opportunity to give them that stock option and have them exercise it and not have that income inclusion until they sell the shares. Now, in all practical circumstances, this doesn't have a huge impact because generally people only exercise stock options when it's advantageous for them. And they'll exercise the stock option and then immediately sell the share. And in that case, there's really no advantage to being CCPC compared to non-CCPC, but it's something to consider. You can roll over your shares into that combined corporation and not receive capital gain. So generally, if your corporation increased in value over time, and you sell those shares, you'll include a certain amount in your income. However, this allows you, if you roll over those shares within 120 days after your corporate year end, you'll be able to do that and roll it in tax-free. Again, this will take priority over the capital gains exemption, so you would roll it in and you'd still have availability of the $750,000 lifetime exemption.
Does this require valuation of the corporation?
Generally, valuation is only done on audit. So you would value a corporation at a fair market value. So if you're selling to an arm's length person, you would not typically require a valuation. If you were selling to a related person, so that's not only a blood relation, but it's also a corporation that you control or any other entity that's controlled under that corporation, then it's generally advisable to get a few valuations.
Well, I mean, the shares are rolled into a new entity. There is no valuation. It's just
No. And typically what will happen is that there'll be initial value for the shares when you first start your corporation. So even if it's $1, then it's still the initial value of those shares. And that initial value will roll over into the new corporation. So if those shares in the new corporation are sold at some point in time, it won't have the value at the time that you roll them over. It'll have the initial value at the time that you originally bought the shares. So the tax implications are do not disappear. They are simply deferred. So they're deferred until the time that you sell that second corporation's shares. So that's pretty much it for the tax section of the presentation, but I'm open to questions.
As a tax lawyer, in terms of your specialism, how different is it from how different is your specialism as a tax lawyer from a chartered accountant, for example, and where do your expertise overlap and how are they different?
Sure. There are very specific skills of a tax lawyer that are important, but the primary importance for a tax lawyer compared to an accountant is when you get issues with the CRA. And there's sort of a separate set of expertise. So an accountant will tell you what the implications might be, and a lawyer will tell you whether that path is advisable or not. So the accountant might lay out like 3 different corporate structures that might work for you. A tax lawyer can tell you the probability of taxation in each one of them. So if at some point in time you get assessed by the CRA, a tax lawyer can give you an opinion of, hey, this is the best to go on. You can be very aggressive and choose this one. However, be aware that if you get assessed by the CRA, you're likely to have certain tax implications in the future and perhaps penalties and interest. It's also where a tax lawyer comes into play is often where there's a dispute with the CRA. So you receive an assessment, and it's not the assessment that you would otherwise receive, or you don't have your expectation of an assessment. The tax lawyer would step in place and be able to deal with the CRA. And most importantly, to be able to deal with the CRA in a confidential way. So the difference between an accountant and a lawyer is that a lawyer has privilege. An accountant does not. So the CRA, if they want to see what your tax planning was, they want to see what you chose as the most risky venture compared to the least risky venture. The CRA can ask for that information from your accountant, and they have to give it as part of a court procedure. Even not as part of a court procedure, but the CRA has many tools in their toolbox to be able to demand that information from you. If you deal with a lawyer, then all that information is privileged. So the lawyer-client privilege protects that information from the CRA, and they can't see what advice the lawyer has given you in respect to how risky that different plan or the different avenue you might take might be. And a lawyer can be free to recommend things to you or to tell you things that you can feel free to refuse, but you know that those things that a lawyer tells you will not be used against you in the future by the CRA if you get audited.
But they can be, if that's the accountant's recommendation to you, that is open book to the CRA.
It can be produced, yeah, and it is typically produced.
What about donations and other funds that go into the non-profit organizations or the charities? How are they looked at by CRA? Is it in the same process?
Same process. Essentially, the CRA has many powers of investigation. They can go to individuals' homes, they can look through papers, they have a very wide breadth of what they can do to discover the information that you might otherwise want to keep confidential. And if you don't produce that information, then there's criminal liability associated with it. And particularly, there's a particular emphasis at the CRA on charities. It's an area that's fraught with a lot of complexities, and the CRA looks very carefully at registered charities because it's reducing their tax that they take in by giving official donation receipts. And so if you are considering organizing a charity, it is advisable that you seek either experienced accountant's advice or a tax lawyer's advice.
What can trigger?
If you go through your return, you make a calculation mistake, there's a flag that gets flagged at the CRA that gives you a higher probability of being audited. If you do certain things like claim moving expenses or claim certain type of deductions for a charity or are a nonprofit organization, or donate to different organizations overseas or hold overseas property, those are all triggers that might occur. There's also focused groups that they'll target, so they can target sort of people above a certain income range or people that hold a certain number of corporations. Yeah, so that's a sort of a general outline too.
Is there one more last question from any of your hands? Yes, please.
A question about limited liability partnership. Partnership, when you have a partnership, you submit your personal tax report, right? In limited liability, does every partner submit a personal tax report, or it is not a legal entity, it's not a separate legal entity, right?
That's right, it's not a single entity.
So every partner submits his or her own.
That's right. There's a separate return that's filed in respect of a partnership, either a limited partnership or a regular partnership. But that return doesn't deal with taxation. It's just an information return. And all that income, any income that's acquired by the partnership or any loss that is acquired by the partnership flows right through to the individuals in their percentage ownership.
An information report,
Say that again, sir?
the information you said one is not about taxes, not the tax report, but the information report. Where does that information report goes to?
It goes to the CRA.
Well, sorry?
To the CRA.
Okay, to
The
CRA.
kind of review.
Thank you, that was covering so much in so little time.